Have you ever dreamt of owning a piece of your favorite company? Imagine if every time you bought coffee from Starbucks or scrolled through Instagram or even charged your phone, you were also making money. Sounds too good to be true, right? Well, it's not. Today, we're going to simplify the world of shares, also called equity, and show you how ordinary people like you and me can become owners of the biggest, most successful companies in the world. Get ready to unlock the power of ownership. I'm Alex Wardak, and this is Build Wealth with Wardak. Before we dive in, a quick and important note. The information shared in this video is for educational and informational purposes only, and is not intended as financial advice. I am not a licensed financial advisor. Investing involves risk, and your individual financial situation is unique. So please consult with a qualified financial professional before making any investment decisions. So, what exactly is a share? Think of it like this. When a company needs money to grow, maybe to build a new factory, develop a new product, or expand into new markets, they can sell tiny pieces of themselves to investors. Each tiny piece is called a share or stock. When you buy a share, you become a part owner of that company. Why would you want to do that? Well, as a part owner, you stand to benefit if the company does well. If the company makes more money, your share becomes more valuable, and you can potentially sell it for a profit. Some companies even share a portion of their profits with shareholders, called dividends, like a little thank you for being an owner. Today, we're going to break down everything you need to know about shares, from the basics to some powerful strategies that can help you on your investment journey. Don't worry, we'll keep it simple and easy to understand. No fancy jargon, just practical knowledge. Not all shares are created equal, just like people. Shares have different personalities and characteristics. Let's talk about two main types: growth shares and defensive shares. First, growth shares. Imagine a young, energetic startup that's innovating rapidly. Growth shares are typically from companies that are expected to grow their earnings and revenues at a much faster pace than the overall market. Think of tech companies, biotech firms, or new up-and-coming firms. They might not be paying big dividends because they're reinvesting their profits back into the business to fuel that rapid growth. The idea here is that the value of the share itself will increase significantly over time. On the other hand, we have defensive shares. Think of these as the steady, reliable friends. These are companies that typically perform relatively well even during economic downturns. They often provide essential goods and services that people really need regardless of the economy. Utility companies, consumer staples, or healthcare providers. They might not grow rapidly, but they offer stability and often pay consistent dividends, providing a steady income stream. They're like the sturdy oak tree, less affected by the winds of economic change. Now, let's look at two popular approaches to investing in shares: growth investing and value investing. Growth investing is exactly what it sounds like. You're looking for those high growth companies we just discussed. Growth investors believe that these companies, even if their shares seem expensive today, will grow so much that their future value will far outstrip their current price. It's like betting on the next big thing. You're focused on potential future earnings and market disruption. Value investing is a bit different. Value investors are like treasure hunters. They search for companies whose shares they believe are undervalued by the market. This means the company's true worth is higher than what its shares are currently trading for. Perhaps the market is overlooking a strong business, or there's some short-term bad news that has depressed the stock price. Value investors look for solid companies with good fundamentals that are currently on sale. They often focus on metrics like a company's assets, earnings, and dividends, looking for a bargain. Now, you might know him. Warren Buffett, one of the most famous investors of all time, is a classic value investor. So you've got growth, you've got value. But what if you could have the best of both worlds? Enter the GARP strategy. That stands for growth at a reasonable price. Now that we understand the basics of different share types and investing styles, now let's look at some powerful strategies and principles that many investors use. Remember, these are general approaches, and what works for one person might not be right for another. Always consider your financial situation and goals. And if in doubt, speak to a financial advisor. GARP investors try to find companies that have strong growth potential, like growth stocks, but are also trading at a reasonable valuation, like value stocks. They're not chasing the most expensive, nor are they just looking for any cheap stock. They're looking for that sweet spot where a company has solid growth prospects, but hasn't ridiculously been overpriced. It's about finding quality growth without overpaying. This strategy attempts to combine the upside potential of growth investing with the downside protection of value investing. It's a balanced approach that many successful investors apply. Now, let's talk about a powerful strategy that can help you invest consistently and reduce risk, especially when you're just starting out. It's called dollar cost averaging. Imagine you want to buy shares in a company. You could buy all your shares at once, but what if the market takes a dip right after you buy? You'd be starting at a loss. Dollar cost averaging solves this problem. Instead of investing a large lump sum at once, you invest a fixed amount of money at regular intervals, say $100 every month, regardless of whether the share price is high or low. Here's why it's so smart. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over time, this strategy averages out your purchase price. You end up buying more shares when they're cheaper and fewer when they're expensive, which can lead to a lower cost average per share over the long run. It takes the emotion out of investing and helps you avoid trying to time the market, which is incredibly difficult even for professionals. It's a disciplined, systematic way to build your investment portfolio. So, how can you apply what we've learned today? Here are a few applicable strategies and practical steps you can take, even as a beginner. Strategy 1. Start small and be consistent. So start with something like dollar cost averaging. Don't feel like you need a huge amount of money to begin. Even $50 or $100 a month can make a difference over time. Set up an automatic transfer from your bank account to your investment account. Consistency is key. Strategy 2. Think long term. Investing in shares is not about getting rich overnight. It's about letting your money work for you over years, even decades. Short-term market fluctuations are normal. Focus on the long-term growth of the companies you invest in. Strategy 3. Diversify and diversify. This is crucial. Don't put all your eggs in one basket. Instead of buying shares in just one company, spread your investments across several companies, different industries, and even different types of shares. Growth and defensive, for example. This reduces your risk. If one company struggles, your entire portfolio isn't wiped out. A simple way to diversify is through ETFs, exchange traded funds, or mutual funds, which are essentially baskets of many different shares. We'll cover those in a future video, but know they're a great way to get instant diversification. Strategy 4. Do your homework, even a little bit. Before exploring any company, it's beneficial to do some research. These are general examples of how one might look at a company, not a recommendation to buy or sell. What does the company do? Is it profitable? Does it have good management? Don't need to be a financial expert, but understanding the basics of the business you're investing in is important. Let's look at some simple ways to do this. When looking at a growth share, you're trying to spot companies that are likely to expand rapidly. Check 1. Is their revenue growing fast? Imagine a new online delivery business. If last year they made $1 million and this year they're on track for $5 million, that's a huge jump. You'd want to see if their sales are consistently jumping up year after year. A company that sells more and more stuff each year is a good sign for growth. Check 2. Are they shaking up an old industry or creating a new one? Think of companies like Netflix shaking up traditional TV or Tesla pushing electric vehicles. If a company is doing something truly new or much better than the old way, it has huge potential to grow and capture a big market. Look for their secret sauce or competitive advantage. Check 3. Do they invest profits back into their business? Growth companies often don't pay big dividends because they're pouring money back into research, development, or expanding their business. They believe that reinvesting will create even more growth in the future. For a value share, you're looking for something that seems like a good deal, a solid company that the market might be overlooking. Check 1. Is it an established company with steady profits? Think of a big, well-known food company that's been around for decades, or a major bank. They might not be growing at breakneck speed, but they consistently make money. Look for a long history of being profitable. Check 2. Does it pay a consistent dividend? If a company has been paying out a regular dividend for many years, it often signals a stable, profitable business that has extra cash to share with its owners. This can be a reliable income stream. Check 3. Does it look cheap compared to its peers or its history? This can be a bit more advanced, but simply put, if a company is making good money, but its shares price seems low compared to similar companies or compared to its own price 5 years ago when it was making less money, it might be undervalued. It's like finding a quality item on sale. Understand your risk tolerance. Investing in shares involves risk. The value of your investments can go down as well as up. Before you start, think about how much risk you're comfortable with. If you're very risk averse, defensive shares or more diversified funds might be a better starting point. Remember, when you buy a share, you're not just buying a piece of paper or a digital number. You're buying a piece of real business. You become an owner with all the potential benefits that come with it. The world of shares might seem intimidating at first, but by understanding these basic concepts, what shares are, the difference between growth and defensive shares, growth and value investing, the GARP strategy, the power of dollar cost averaging, and simple ways to analyze them, you're already miles ahead. You have the knowledge to start building your own path towards financial growth. Investing is a journey, not a sprint. Be patient, be consistent, and keep learning. The more you understand, the more confident and successful you become. A final reminder, this content is for educational purposes only and does not constitute financial advice. Always conduct your own research and consider consulting with a licensed financial professional who can provide advice tailored to your personal circumstances. If this episode helped you on your journey to build wealth, please take a moment to subscribe or follow the show wherever you listen to podcasts and leave a quick review. Your support truly helps us reach more people. I've got more episodes coming on practical income strategies, property, and building real wealth. For more resources and to connect with me, check out the links in the episode description. This has been Build Wealth with Wardak. Thanks for listening. I'll see you in the next one.